Do you run a photography studio and you want to pay as little as taxes as possible? After watching this video, you will know all the strategies that I go over with my clients. My name is Travis Reynolds. I'm a CPA and I help photography studio owners run more profitable studios. So the first thing that we are going to go over, I know is not the most sexy answer, but it is true. You need to have a good record keeping system in place. So this means having a good bookkeeping system, such as using QuickBooks Online or Xero. You can do a spreadsheet if you like, although I don't like spreadsheets because spreadsheets work until they don't. If you use software such as like QuickBooks, you can connect your bank and credit card accounts and all of your transactions can download automatically, where you can categorize all of your expenses and then you can reconcile to make sure nothing is missed. If you go the spreadsheet route, it is a very manual process, and if you miss expenses, you're gonna be paying more in taxes because you are not getting that write-off. So basically the point I'm trying to make here is you need to make sure you are capturing every single penny of all of your write-offs. If you miss $1,000 in deductions, that could make your tax bill go up by $200. So this is why it's so important to keep track of all of your income and expenses. The second thing I go over with my clients is that one of the first questions I ask them is how profitable they are. If they tell me that they're probably making at least $100,000 in profit, typically I will tell them they should probably be an S corporation, because when they're not an S corp, they are paying what is known as the self-employment tax, which is a flat 15.3% on 100% of your profits. And when you are an S corporation, basically you get to get on payroll, pay yourself a reasonable salary, such as, well, for this example, we'll say $60,000. Then you only have to pay that self-employment tax of 15.3% on what you pay yourself. Everything else is just subjected to regular federal income tax. So basically that would mean $40,000 are not subjected to that self-employment tax of 15.3%. And if you're not familiar with, basically that 15.3%, it is equivalent to the employee and the employer portion of the Social Security and Medicare taxes that you'd be paying if you were a W-2 employee. The third tip is going to be do a reasonable compensation study. The purpose of a compensation study is to know how much you can pay as little as possible and still hit the reasonable requirement with the IRS. And you want to pay yourself as little as possible because when you're doing that, you are paying less payroll taxes. Again, that 15.3%, you're paying less of that. But also when you pay yourself less, the business will have a higher profit. And when the business has a higher profit, you will actually get a bigger qualified business income deduction, which is basically 20% of your profit that you get right off just like that. So by paying less in payroll taxes and getting a bigger deduction, you generally will be paying less taxes over time. The next thing we kind of is to make sure to claim the home office deduction if that is applicable to them. So to qualify for the home office deduction, the photographer must have a space in their home used exclusively for business. This doesn't have to be a whole entire room. It can just be a desk, but basically the bigger the space that is used exclusively for business, they will get to write off part of their living expenses. This can be things such as mortgage interest, real estate taxes, rent, utilities, repairs and maintenance, internet, HOA fees, things like that. And after that, we always go over mileage. As a photographer, you drive all over the place. If you have that home office deduction, basically any place that you drive from your home to those shoots, you can write off the mileage. For 2025, the deduction is 70 cents per mile. So, if you drive 1,000 miles in a given year, that's a $570 deduction you can take. But it doesn't have to be just towards shoots. Like you go into the photography store, or if you're going to the office supply store or the post office, basically anywhere you drive for business, you can write off. So just like recording your income and expenses, I don't recommend to do it manually, just because if you miss one, you are overpaying in taxes. So I definitely recommend they have apps on your phone that you can use, and it'll do it all in the background for you, so nothing is missed. And the beauty of paying for these apps to keep track of your mileage and also your income expenses, such as QuickBooks, is you can also write those off to help pay less in taxes. The next step comes down to timing. So if November or December, and if you think you're gonna be making a new camera purchase or some big purchase come in January, February, March, I would try to push you to do it now in December or November. That way you can lock in those tax savings in the tax year and write them off. Otherwise, if you buy those equipments in January, February, March, you'll have to wait a full year before you can recognize those tax benefits. Next one is what I stress to everybody is retirement. I love telling people to contribute towards retirement. Putting away money for retirement is basically you're just taking money from one bank account and you're putting it into another bank account, and you get to write that off basically on your income. If you put $5,000 away for retirement, you are building wealth, you're gonna let it grow, and you basically get to deduct that $5,000 from your income. So I always recommend retirement. Next one, if you are single or if you are married and your spouse doesn't have health insurance, I always recommend health insurance. This is very important for staying healthy, and you get to write off that health insurance. So if you don't have health insurance, I definitely recommend to get health insurance. All right, this next one is gonna sound counterintuitive, but one of the best ways to pay as little tax as possible is to pay your taxes when you are supposed to. And I'm talking about quarterly estimated tax payments here. If you are not paying your quarterly estimated tax payments, you are basically paying a penalty when you go file your taxes. So if you're not paying taxes throughout the year, look at your tax return from last year. Towards the bottom where it says you owe, there typically is an underpayment penalty that got applied to your balance. Think of that underpayment penalty as like a monthly subscription. If you are not paying taxes throughout the year, divide that by 12. That's how much you paid every month for not paying your taxes on time. So I definitely recommend make your quarterly estimated tax payments. If you need help making quarterly estimated tax payments, I did make another video with a calculator that I made that you can grab, and it will help you calculate how much you should put away for quarterly estimated tax payments for both federal and state. And there's also the links on where to make those payments. So that's pretty much all the tips that I got for you. That's typically what I go over with a client when they always say they want to pay the least amount of taxes. If you got any other questions, feel free to drop them in the comments below and I'd be happy to answer them. So stick with me and I'll see you in the next video.